Hey everybody, what's up? It is Wednesday, May 6th. We're in the doldrums here. In the doldrums. I'll get to the market in a second. Let me talk about the EIA weekly petroleum status report that came out today, as it does every Wednesday. Of course, I do a whole write-up on that, a whole analysis of that. So, more green shoots, what I've been talking about now for the past few weeks. The report did have some negatives in there. I have to put that out there first, but overall I would say it's a bullish report. And also keep in mind that this report really does not reflect the OPEC production cuts. So in the coming weeks we'll really start to see the impact of that. But let's go over it. First of all, on the plus side, we had a much smaller build in inventories than expected. It was a 4.6 million build in crude inventories. That was the smallest increase in 6 weeks. We had another draw. It was like a 2 million something draw in gasoline. Now that puts gasoline, I think that's the second draw in gasoline, and it puts gasoline stocks down to the lowest level in 6 weeks. We had a very nice pickup in gasoline demand, up 805,000 barrels per day. By the way, that was the biggest 1 week increase since December 2014. But of course, it's coming off a low base, and it's just now due to the economy slowly starting to open back up. But a nice improvement there. That was the fourth week in a row. Remember, I've been telling you, going back 4 weeks, I said, got a little bounce up in gasoline demand. And the second week, I said the same thing. And last week, and now here, the fourth week up. So we are at the highest level of demand in 6 weeks. That's good. U.S. domestic crude production fell by 200,000 barrels per day. That puts it down to 11.9 million. That's we're already 1.2 million barrels a day below the peak production that we saw in February. Remember, we got up to 13.1 million, I believe it was. We're down to 11.9 million. And the 200,000, that's double the decline that we saw last week. So that's positive. Crude exports up nicely. One of the things that were a little worrisome was refined product exports down sharply. It might be a 1 week thing. We'll have to see where that goes next week. But again, I would say on balance, this report is bullish. There were some negatives in there, like that refined product export number. Also, distillate inventories were up 9.5 million. That's a big jump up. Got a problem there with the distillate build. But again, it does not reflect the OPEC cuts, and we're going to see continued declines in U.S. domestic crude production. So that's bullish. So overall, the market pulled back today, oil pulled back, but I think it's going higher. Let's talk about stocks. We are basically in a stall right here as far as the market averages are concerned. If you look at sentiment now, we're really in this kind of a level where there's no extreme. We're not extremely overbought. We're not extremely oversold. I contend that the fundamentals are still positive. The fundamentals, what am I talking about? You might say, Mike, you're crazy. Look out the window. Fundamentals. Everybody's walking around with a mask. We still have lockdowns in certain places. Yes, I understand that. I'm speaking from an economic, the fiscal point of view, the core of my analysis. It's continuing to expand. Government spending now, as of yesterday, was 713 billion over where it was at this time last year. I keep going over that number. It's very important that you understand. Last year was a record. We are already 700. And by the way, this all happened in 1 month. It's not like this took, 2 years to accelerate. I'll give you another statistic. Unemployment benefits now at 82 billion. Last month in April, not that far away, okay? We're not even talking about a full month. It was at 17 billion. So, you've ramped up enormously. What was that? 65 billion increase in less than a month. I mean, that is significant. It's beyond significant, and that is a great help to many, many people. I mean, if we didn't have that, then there's no way that we'd even be having a conversation about the market where it is right now. But the fiscal continues. I think there's another fiscal package now being hammered out in Congress. The Senate has one. The House has yet to come back to work, but I mean, they're going to come up with one. So there will be another one. But right now, the fiscal is supportive. It has to continue. And again, it all is premised on the economy opening back up and hopefully not having another spike in viral infections and another period of lockdowns. I mean, if that happens, obviously, then, the scenario changes dramatically. But we don't know that right now. What we do know is what we know, that the economy is opening back up. The fiscal support is unprecedented. It's growing every day. By the way, the growth rate of spending now at 23% year over year. I mean, that dwarfs anything that we have ever seen. All this stuff from the fiscal side. Could it be better? Yeah, obviously it could be better. It could go to, all this aid, all this support is not necessarily going to the most in need. But you got to look at it in the aggregate. I mean, the markets are going to reflect it in the aggregate. Corporate profits, the spending flows to profits as things start to open up. As a matter of fact, we saw some earnings reports actually weren't too bad. But obviously, looking forward, that's another question. So that's where we are. Yesterday I spoke about that German court ruling against the ECB. We saw more weakness today in the euro. I'm buying it down here. I am buying it down here. The Fed is active still with its forex swaps. There's still that so-called dollar shortage. I was talking about that in my video, I think yesterday or the day before, that in the last week we saw another 29 billion in those central bank liquidity swaps. Those are the forex swaps. The Fed offers dollars to foreign central banks if their systems are short dollars. So that's still happening. I mean, as long as that's ongoing, we could assume that this dollar shortage problem is still in effect. But the movement in the dollar now is very modest in percentage terms. So, I mean, it's not an acute problem. It's being dealt with. We had a pullback in gold today. 1670 is, I would call it, light support. That was the last price level where we saw commercials active as buyers. Not aggressively, but they were there. And by the way, for the last 2 years, I mean, going back to 2018, the amount of gold hedging on the part of commercials has been really small. I mean, surprisingly small. So, they see a strong market is in terms of the price. Otherwise, they'd be selling into this thing aggressively. I mean, we're up at, 9-year highs? 9-year highs? But it's just not there. I mean, they sell a little bit on rallies, but they're mostly buyers on the dips. I'm taking my cue from that. All right, everybody, that's the update for today. Stay safe. See you tomorrow. Bye-bye.